Anyone who believes in indefinite growth on a physically finite planet is either mad or an economist.
We don't want to focus politics on a notion that involves the rejection of principles around which a large majority of our fellow citizens organize their lives.
We are not as endlessly manipulable and as predictable as you would think.
This year is actually money's 40th birthday. So money as we know it today actually isn't terribly old. In fact, it's exactly 40. It was 40 on the 15th of August, 2011, because that was the 40th anniversary of Richard Nixon ending the convertibility of the US dollar into gold on the 15th of August, 1971. So up until 1971, money was, however loosely, and however it was technologically implemented, anchored in something. And since the 15th of August 1971, money has been essentially a completely virtual, imaginary concept. And now that it's 40, it's having a bit of a midlife crisis. We tried buying it a sports car called quantitative easing, and that hasn't worked terribly well. It's still rather restless and doesn't really know what its role in the modern world is. So now is a good time to reflect on how we got here and the kind of changes that money has to make. So let's cast our minds back to 1724 in what I still refer to as British North America. Now, in the colonies, a typical contract, for economic activity, a typical contract might be something along the lines of, I want to rent this field from you, and I promise to pay you £1 in gold every 5 years for the rent of this field. In that context, it was really quite interesting because, first of all, nobody had ever seen a pound. In the North American colonies, a pound was an entirely abstract concept. Nobody had any pounds. The people there were second generation. They'd never seen a pound, and yet you could still write contracts to each other in pounds, and everybody knew what you meant. The pound, even though the pound didn't exist, the pound was a unit of account that was perfectly acceptable for the purposes of commerce. We didn't have any gold either. There was no gold in North America. There wasn't any silver either, actually. So the payment would be commuted into an acceptable local currency, which generally speaking at that time was the famous wampum, the seashell money. So I'm going to pay you £1 in gold, but I end up paying you a big pile of seashells, which are actually rather inconvenient. Once you begin to accumulate them, you naturally want to exchange them into some form of reserve currency, which at that time the Native Americans were the sort of reserve bankers of the system because they would accept wampum unequivocally, and so you would trade it to them when you had enough of it, generally speaking for animal skins. Beaver pelts in particular were very, very excellent because they had an external value as well as an internal one. The reason for telling that story is just to illustrate that what economists such as Diane refer to as the functions of money are actually very different. There was money in that story as a unit of account, the pound, the store of value, the means of exchange, the wampum, the mechanism for deferred payment, the gold. These functions were all implemented in different ways, and as a consequence, the impact of technological change is very different on each of those functions. So when you ask what appears to be a simple question, which is, what is the future of money, what is technology going to do to money, the first thing you have to understand is that technology impacts those different functions in different ways. And understanding the interplay between those is a very important part of understanding where money might go. Shortly after the Norman invasion, taxes became a very effective mechanism for deferred payment. They were very stable, they were a known quantity, they were collectible because of the military junta we were living under. So what would happen is the king and the sheriff would agree on the taxes due for a county, let's say a county as a tax base. So we would agree that next year Nottingham has to pay whatever, I don't know, £10 in tax or something. That would be our sort of. And what happened was a very interesting invention came along, a very small piece of technology which made a huge difference. And this was the tally stick. So what would happen was, I agree with you that the taxes are due for £10 in Nottingham next year. And what we would do is we would take a stick and we would make notches in that stick which recorded the amount Jew, and we'd write on it where it was from. And then we would split the stick in two, and the king keeps half of the stick, and the sheriff keeps his half of the stick, and off he goes. And when he comes back next year with the taxes, you put the two halves of the stick together, hence the expression tallying up. You put the two halves of the stick together, and you can check that he's paying the right amount of taxes. Now, that was a wonderful technology because it was very simple. You know, anybody could make these sticks. It was very easy to notch them, but it was very difficult to forge them. The tally sticks were a mechanism for deferred payment, but the technological implementation rapidly turned them into a store of value. And this is why. Once we'd split the stick in half, the king, generally speaking, couldn't wait until next year for his share of the loot. They don't. You know, they never do. So what the king would do is he would sell his half of the tally stick at a discount, which, of course, to an economist is equivalent to a fixed interest loan, but not to God, who's not so strong on monetary policy. So we were able to get around that. So we can't borrow money at interest, so what we do instead is we sell our half of the stick at a discount into the market. And what this meant was within 100 years, by about the 1170s, there was a fully functioning market in government debt centred on the City of London, a fully functioning market, which would discount the tallies across time and space, because obviously if you held a tally stick for somewhere nearby, that was worth more to you than for one far away, because you had to go to actually collect the money. And also, if you had a stick that would fall due soon, that was worth more to you than a stick that would fall due in a long time. So you had a discounting across time and space. And the market could price that very efficiently. And merchants very rapidly began to want to acquire the tally sticks as a store of value, because it was easier having a box of tally sticks than a box of, you know, gold coins or whatever. So you would want one of these sticks, even if you had no intention of collecting the taxes that would fall due, because it was a more efficient store of value. So the new technology shifted something from being one of those categories, a mechanism for deferred payment, into another, which was a store of value, and then eventually into a means of exchange, albeit for sort of larger values, and had quite unintended consequences. Nobody had intended to create a money market in government debt by inventing a tally stick. But what it did was it enabled this new kind of market, which actually was very good, because the way it priced out that debt made for an efficient market. The final story I want to tell also dates from around 1724, and this is the story of the reshaping of the monetary landscape after the Glorious Revolution of 1688. Now, at the time, the coinage, because the only circulating means of exchange at the time was coins, was in great disarray. And there were several problems. So first of all, there was terrible problems with counterfeiting, because nobody could tell which coins were real and which one weren't. There was a big problem with coin clipping, because you remember the old stories. People would clip bits off the edges of the coins and melt those down. And also, actually, the coins were vanishing in bulk, because they were mispriced at the mint in London. So actually, the coins were worth more as bullion on the continent than they were here. So people would take all of the good money, the good silver coins, would be packed up and shipped off to the Netherlands and Belgium and so on, and would be melted down to make bullion that was worth more. Then some of that bullion would be sold back to the government in order to make some more coins, which were then re-exported. Because, to be quite honest, markets are always cleverer than governments when it comes to this sort of thing. They always win. But it was impacting trade and commerce. As I said before, trade is the issue here, you know. And because there was no money, that limited the extent of trade. So they decided to do something about it, which I think speaks to the spirit of the times in which the RSA was founded. Because what they decided to do was write to the cleverest people in the country to ask them what to do. And the cleverest person in the land, in fact, quite possibly the cleverest person that's ever lived, Isaac Newton, wrote back with some solutions. And his solutions were so good, they actually installed him as the master of the mint, the latter part of Newton's career. And it was Newton, in fact, who instituted the Great Recoinage of 1696, which called in the collapsing silver currency and rebuilt it. And what he did, essentially, I mean, you know, we see this explanation now with the wisdom of hindsight, looking backwards. What Newton did was match the money to the economy. So essentially, we had an industrializing economy, but we had pre-industrial money. At that point, the coins were still struck out by hand. And so what Newton did was it brought in machines and made machine production of coins. and those coins were of uniform quality and weight. He also came up with the idea of milling the edges to stop the sort of coin clipping. And had a huge, all the money was called in and melted down and recoined using the machine currency. And by the time Newton died in 1727, we had the Bank of England, which was founded in 1694. Remember, that was founded by private industry, not by government. We had paper money in circulation because of the existence of the Bank of England. We had a reliable silver coinage. We had the first copper, what they call token money, going into production, again produced by private industry, not by government. And we had the rudimentary gold standard. In 1688, when money wasn't working properly, all of those things would have been inconceivable. You know, if I'd have stood here at that time and said, you know, what we need is some kind of like big sort of private central institution that's going to issue some pieces of paper, and we'll use those pieces of paper instead. Unthinkable. What we should do is we should make coins using machines instead of by hand. Crazy. You're going to put all those people out of work. And yet within a generation we had a completely different monetary system which funded an industrial revolution and a continuous rising living standards for about 150 years. My contention as to why we should discuss the future of money now is based on the intersection of three pressures. We still think of money in the sort of wrong way. The way we think of money doesn't match the way money should be used and exist in the modern... In fact, there are a great many people who still think that there's gold in the Bank of England. I mean, the mental model is wrong. People think that pounds are actually sort of worth something, and there's something behind them, and of course there isn't. They're a debt. We're in a post-industrial age. We're trying to construct a post-industrial economy which has a new basis for trade and prosperity. It's different from what it was in an industrial age, different from what it was in the pre-industrial age, but we're still using the industrial age money. We're still essentially using the same institutions, the same money. We're using the wrong money, and it's not working properly. The second pressure, I think, is social. Cash is a very bad product. It transfers money from the poor and honest, broadly speaking, in society, to the rich and the dishonest. The cash in circulation in the UK, which is about £40 billion, is about 3% of the broad money supply. And in Norway, you know, roughly 70% of the cash in circulation is only used for tax evasion, drug dealing, money laundering, corrupt politicians. It's not used for commerce in any sense. We don't need it anymore. The people that want cash are the people that want to use it for bad purposes, and also people who don't understand any different. And if you're poor, if you're trapped in a cash economy, you are discriminated against very heavily. You know, when I get the thing from British Gas saying, thank you for paying by direct debit, you're saving £80 a year or whatever it is. But if I was trapped in a cash economy, I don't have that option. If I have to pay cash for my gas and electric, I pay more. If I'm trapped in a cash economy, I can't take advantage of the deals that you get online where everything's cheaper. So the idea that cash is the benchmark, cash is neutral, cash is the root, is wrong. I think in social terms, it's come to the end of its useful life. And you don't have to be Greece or Italy to see that the seigniorage benefits to the exchequer are vastly outweighed by the losses in crime, tax evasion, and so on and so forth. So we thought for a long time, you didn't, but I did, that things like checks and cards would eventually eat away cash. And they have done, but very, very slowly. Essentially, if you're wealthy, you use credit cards and debit cards. You very rarely use cash. Still, in the UK, you know, probably, I think it's 58, 59% of retail transactions are still in cash, which is a quite surprising figure. You know, if you go to somewhere like Iceland, which is literally the most cashless country in Europe at the moment, something like 94% of retail point-of-sale transactions are non-cash, almost all on debit cards. We finally have the equivalent of the tally stick. We finally have the equivalent of a simple technology which makes it possible to replace cash, which means, I think, that those unintended consequences will again come into view. And that technology is the mobile phone. It's the mobile phone that changes everything in this space. The mobile phone is a truly disruptive piece of technology, and it's going to disrupt money just as much as it disrupts other things. My debit card is great when I'm in a shop. If I want to pay a shop, my debit card works absolutely fine. But if I want to pay Diane, it's a bit of a problem. because she's got no means of accepting money. And this is the critical role of the mobile phone. The mobile phone isn't just a way of paying people. We're all looking forward to the day, starting next year, when TfL will fix it so that I can take my splendid Barclays orange Samsung Toco phone and ride the subway and the buses without having to buy an Oyster card. That's not very far away. That's going to be great, and I'm really looking forward to it. But that's not disruptive. That's taking something we already have, credit and debit cards, and putting them inside phones. What's disruptive is that you'll be able to pay my phone. You know, everybody having a card hasn't got rid of cash, but everybody having a terminal will. So when everybody can pay everybody else using their mobile phone, just by simply sending a text message, as they do in advanced countries like Kenya, or by tapping the phones together, as they do in advanced countries like Japan, we're not very far away from the point where the average person, not the geek, but the average person won't need cash anymore. And when there's no cash, I see two routes we could take. We could take the route, essentially, of reaction or revolution. You see some people who are calling for, let's go back to the gold standard. Let's go back to, the 1950s or the 1850s or actually the 1650s. Let's go back to a silver standard. So you see people, let's go back. And I don't see that. I think, I'm more down the revolution side. What the mobile phone does is decentralize and distribute the ability to create money. The future isn't about one money, it's about millions of monies. It's not about the government creating new money, it's about you creating new money. It's not about what the Chancellor of the Exchequer thinks about it, it's about entrepreneurs thinking up fantastic new ways to use that tally stick, which will eventually create a market. So the future of money isn't a money. The future of money is millions of monies.
The young people in the People's Republic of Wessex of tomorrow who've all got their mobile phones, how do they get that millions of money that you're talking about? Is it their local exchange trading scheme? Do they come to the RSA and say, please get some clever people to tell us what to do? How does it come about?
I mean, the answer to that at one level is actually I don't know, because I'm not an entrepreneur. I'm an observer. I mean, I think there are smart people out there. You can see the kind of prototypes in two areas, which are both broadly you would label probably community currencies rather than sort of national currencies. So on the one hand, you see people experimenting with, like the Lewis pound and the Totnes pound and the kind of more advanced, lets, moving into an electronic age. Those things never worked when they were babysitting tokens and ledgers. Personally, I think that if you look at online communities, you see possibly more of a window into that future. So when you look at what people are doing with World of Warcraft gold and Facebook credits and things like that, I think those are possibly closer to that. Community doesn't mean what it used to mean in the past. So I think the idea of community money is very strong. I think the decentralized nature of that, the ground up, I think that's all very strong. But I suspect community in a post-industrial age doesn't mean quite what it meant before.